This inflation which we've seen over the last 2 years or so, I have no doubt in my mind that if the economy recovers, prices in the economy are going to go through the roof. In fact, I don't even think it is impossible to imagine that the price levels in the United States are going to at least double within the next 6 to 7 years.
And now the Fed is tightening, so they've basically ended QE. They're going to raise interest rates, and the financial conditions are going to get tighter. I don't think we're going to get fiscal stimulus next year. We've already basically seen peak liquidity. I still feel that inflation is going to peak this year, and it's going to come down pretty dramatically towards the back half of the year. Because if you look at the causes of inflation, we had obviously a massive QE done by the Fed and also most other central banks, and an unprecedented amount of fiscal stimulus, which was effectively the government just sending out checks to households to spend. That was inflationary. On top of that, you had supply chain constraints, and now finally we've had the geopolitical conflict. So we've had a perfect storm for inflation. But if you look at the factors, these in my view are still transitory factors. They're not, in the same vein as the 1970s. I think the situation is quite different today than it was in the 70s, when we had that persistently high inflation for the entire decade. I don't think we're in a similar situation right now. I believe that most of these factors which cause inflation to spike are basically on their way out. And we are likely to see a much lower CPI print in the back half of the year and lower still next year.
We see what's been going on in the market. More and more stocks are getting shot. A number of these high growth companies, they announced fantastic results for the recent quarter. And they beat the estimates, they beat the guidance. Everything was fantastic. And instead of going higher, these stocks fell 15-20%. And this is, in my opinion, a classic sign that the market has actually discounted the best that can be seen for the time being. And one by one, a lot of the stocks are basically topping out and rolling over. If you look at some of the FinTwit darlings from the last year and a half, the Pelotons, the Teladocs, Rokus of this world, and some other names also, Zoom, for example. These are all work from home stocks which peaked. But more and more companies I find now, they're basically market caps are shrinking. And a number of the growth stocks, high growth stocks, are now already down 50-60%. Some of them have just started their decline. And the weakness, in my opinion, is now spreading to the broad market. And it is noteworthy that whenever tops happen, Dave, it's not a single day event. It is generally a process which takes several weeks to several months.
Well, obviously the Fed, ramped up the money supply growth, and we had huge QE. The money supply basically went through the roof, and now the Fed is tightening. So they've basically ended QE. They're going to raise interest rates, and the financial conditions are going to get tighter. I don't think we're going to get fiscal stimulus next year. We've already basically seen peak liquidity. On the supply chain front, the supply chains are gradually coming back online after the disruption. So all the factors which basically cause this inflationary spike are likely to recede over the next few months. And monetary policy works with a lag, as you know, Daniel. So whenever the Fed eases, the effects of that easing basically become evident several months down the road. And likewise, when you have monetary tightening, the effects of those tightening are also become evident in the economy, etc., with a lag. So I think we are going to see inflation coming down in the second half of the year.
The key worry for us looking out 3 or 4 years is very high inflation, because central banks over the last 2 years or so have printed gigantic amounts of money. They've debased the currencies, they've transferred the debt from the private balance sheet to the public sector. If you look at the debt levels in the Western world, the debt to GDP ratios are off the charts, not only in the West, but also in Japan, in most of the developed countries. And there is going to be a payback for all this fiscal irresponsibility, and the payback will be a currency debasement or a currency crisis.
at some point in the next 3 or 4 years. So the big concern for us, or the big theme, is to protect the purchasing power of the savings from the consequence of this inflation, which we've seen over the last 2 years or so. I have no doubt in my mind that if the economy recovers, prices in the economy are going to go through the roof. In fact, I don't even think it is impossible to imagine that the price levels in the United States are going to at least double within the next 6 to 7 years. So inflation protection is an absolute must in this environment.
I think we are going to see some pain, and probably we're going to see, if the Fed stays on course of tapering and ends QE, I'm fairly certain that we are going to see a deflationary contraction next year. That is already underway, and I think more and more stocks are eventually going to get hit. And ultimately, I wouldn't be surprised to see an 18 to 20% correction in the S&P 500 over the next sort of year or so. And I'm basing this not on my own whims, I'm basing this on history, because if you see what's happened since the global financial crisis, which is when the Fed started, embarking on QE cycles, every time QE ended, or the Fed's balance sheet basically contracted, the S&P, like clockwork, fell 18 to 20%. So I am basically using history as my guide to see what might be lurking around the corner.
Well, commodities have benefited, like all other assets, from the QE and the money printing we've seen and the fiscal stimulus and so forth. And this huge tide of liquidity has benefited every asset class. So whether you look at stocks, they had a huge run up. The growth stocks went ballistic. They were up 5 to 6, 8x, 10x in a year and a half. The SPACs went vertical. Cryptocurrencies went through the roof because of the excess liquidity and very loose financial conditions. Real estate was booming, still booming in many countries because of money printing and monetary inflation and excess liquidity. And because of that, commodities have also benefited. And now commodities have had a second wind because of what's going on between Russia and Ukraine. Russia's invasion of Ukraine has basically caused commodities to go even higher, especially crude oil. But in my view, this is late cycle behavior. I think as soon as any positive news comes out of Russia and Ukraine, Daniel, I think there's going to be a big washout in the commodity space.
Well, for our clients, Anna, we've invested in the fast-growing emerging economies in Asia. We believe that in this two-tier economy, where the emerging countries are doing a lot better than the countries in the West, our investors are likely to chase performance or the growth which the companies are going to deliver in emerging Asia, in Latin America, and so forth. So we've got positions in China, we've got investments in India, in Vietnam. We also have exposure to resources, companies in energy sector, in the steel sector. We have some precious metals as well, because history has shown that when you have very high inflation or rampant inflation, then commodity prices benefit the most. And companies which are able to deliver growth in a low growth environment are also bidded up by investors.